Have you ever wondered what truly separates, the legendary investors from everyone else? What's the real secret to that kind of enduring financial success, the kind that lasts decades and just generates these staggering returns?
Yeah, I mean, more than just the numbers, right? What's the philosophy underneath it all?
Exactly. So today we're taking a deep dive into the 2021 Berkshire Hathaway annual letter to shareholders. This one's penned by, well, one of the greatest financial minds out there, Warren Buffett.
A must read every year.
Totally. Our mission here is to really unpack the key insights, maybe some surprising facts, and definitely the timeless wisdom packed into this document.
And translate some pretty complex financial ideas into something clear, something actionable for you, the listener.
Right. It's like having a direct line to Buffett's thinking, but without having to wade through all the raw data yourself.
Think of it as the highlights reel, but with analysis.
Okay, so let's jump right in and unpack this. Some of the numbers are just, well, almost unbelievable.
They really are.
If you look at Berkshire Hathaway's overall gain, right, from 1964 to 2021, it was a staggering 3,641,613%.
3.6 million%. It's wild.
And compare that to the S&P 500 over the same time, that was 30,209%. Still good, but, it pales in comparison.
Doesn't it, Jet? And if you break it down annually, the compounded gain from 65 to 21, Berkshire's at 20.1% per year.
Compared to the S&P 500 at 10.5%, it's nearly double, compounded over decades.
Yeah.
These numbers are just mind-boggling.
Yeah. Over 3.5 million% total return. You'd almost think that has to come from some crazy, aggressive, short-term trading thing.
That's what I'd assume. So what's the real secret behind that kind of consistent long-term outperformance? It can't just be luck.
Well, that's a great question because it gets right to the heart of it. And what's fascinating is these numbers actually come from a core philosophy. It's pretty much the opposite of short-term timing.
Okay.
Buffett and Charlie Munger are really explicit about this. They say, Charlie and I are not stock pickers, we are business pickers.
Business pickers.
Yeah. So their investments are based on long-term expectations for the business itself, its performance, not trying to guess where the market's going next week or next month.
So focusing on the fundamentals.
Exactly. Their goal is to have meaningful investments in businesses that have, and this is their phrase, durable economic advantages and a first-class CEO.
Okay, durable advantages, great CEO. Sounds simple, but I imagine it's harder in practice. Do they ever get it wrong?
Oh, absolutely. They're quite open about it. The letter admits their extensive collection of businesses includes some enterprises that have truly extraordinary economics, many others that enjoy good economic characteristics, and a few that are marginal.
So even they make mistakes. That's actually kind of reassuring.
It is. And they point out that it's much easier to get out of a mistake if it's, a stock you can sell and market rather than a whole company you own. It gives them some flexibility.
So that long-term business-focused approach helps them ride out volatility and even fix mistakes sometimes.
That seems to be the idea. It provides resilience. The core philosophy keeps them grounded, even when things don't go perfectly.
And it's clear they really value transparency through all this. They talk about treating all shareholders equally, communicating directly through the letter, the big annual meetings.
Right, the Woodstock for capitalists.
Yeah. And even releasing important news on Saturday mornings. That's unusual.
It is. It gives everyone, individuals, media time to digest it properly before the markets open Monday. It shows a real respect for their investor base, doesn't it?
It really does. Now, shifting gears a bit, when most people think of Berkshire, what comes to mind? Maybe insurance, Geico, maybe Dairy Queen or See's Candies. A big investment fund.
Sure, those are common associations, a sort of large and somewhat strange collection of financial assets, as the letter itself puts it.
But the letter reveals something, well, genuinely surprising, that kind of flips that perception on its head.
It absolutely does, and this is a big one. It turns out Berkshire owns and operates more U.S.-based infrastructure assets than are owned and operated by any other American corporation.
Wow. More than any other. We're talking property,
Yep.
plant, equipment.
Exactly. Railroads, energy grids, the physical stuff. At the end of 2021, these domestic infrastructure assets were valued at a massive $158 billion.
$158 billion. That's incredible.
And the letter adds, Berkshire always will be building. So this isn't just a static holding. They're actively expanding this physical footprint. It totally reframes them. They're woven into the very fabric, the backbone of the U.S. economy.
That's amazing. And it leads to another Pretty surprising point about their economic contribution, doesn't it?
Yeah.
Beyond just building things.
Yes, taxes. In 2021 alone, Berkshire paid $3.3 billion in federal income tax.
$3.3 billion. How does that stack up?
Well, the Treasury reported total corporate income tax receipts of $402 billion that year. So Berkshire's contribution is, pretty significant on its own.
And there's a historical comparison in the letter that really drives this home, right?
Yeah.
About the early days.
Yeah, it's quite a story. Back after the 1955 merger that formed the original Berkshire Hathaway textile company, well, it was kind of a disaster.
Things didn't go well.
Not at all. The company's net worth just cratered over 9 years. And during that entire time, guess how much income tax they paid?
I dread to think.
Only $337,359 total. That's like $100 a day. The Treasury really didn't get much from them then.
Wow. So what changed?
Well, in 1965, new management, that's Buffett, comes in, starts redeploying cash away from the failing textile mills and into better businesses, reinvesting the earnings. And that's when, as the letter says, compounding worked its magic.
Yep.
Now, instead of $100 a day, Berkshire pays the Treasury roughly $9 million every single day.
$9 million a day. That's quite the turnaround. It really highlights that connection between successful business and, well, the government's finances.
It does. The letter calls it an invisible and often unrecognized financial partnership. And just to be clear for our listeners, we're just relaying the facts here from the letter itself. We're not taking any position on tax policy or politics.
Absolutely. Just reporting what Buffett wrote. Now, sticking with Berkshire's unique financial structure, there's this concept of float. How does that work? It sounds a bit mysterious.
It does sound a bit like magic, but it's core to their insurance operations. Float is basically money they hold now, premiums collected, that will be used to pay out claims later. But in the meantime...
They get to invest it.
Exactly. It's money they hold and can invest, but it doesn't technically belong to them. It belongs to the policyholders eventually.
How much are we talking about?
Well, it's grown enormously, from just $19 million when they first got into insurance to $147 billion by the end of 2021.
Whoa, $147 billion of other people's money that they can invest for Berkshire's benefit.
Pretty much. And the amazing part, the letter states this float has actually cost us less than nothing.
Less than nothing.
Because their insurance businesses, on the whole, have been profitable before considering the investment income, they've run underwriting profits over 55 years, so they get this massive pool of capital, essentially for free, or even better than free.
And it's sticky money, right?
Yeah.
It doesn't just disappear overnight.
Right. Insurance claims are paid out over long periods, so the float is very stable, long-term capital, perfect for their long-term investment style. It's a huge advantage. And interestingly, this growth in float isn't always perfectly captured by standard accounting rules, like GAAP earnings.
So the true value might be a bit hidden sometimes.
It can be, yeah. It requires looking a bit deeper than just the headline profit number.
So how do they get so good at this insurance game? It seems central to everything.
Well, a huge part of that story is Ajit Jain. Buffett hired him back in 1986. The story goes that when Buffett asked about his insurance experience, Ajit said,
Let me guess. None.
Exactly, none. And Buffett apparently quipped, nobody's perfect.
Yeah, class.
And Jain turned out to be, in Buffett's words, as perfect a choice as could have been made. He's been instrumental for 35 years. It really shows how much Buffett values talent and judgment, maybe even over specific experience sometimes.
Incredible story. So the letter then moves on to talk about what it calls Berkshire's four giants. These are the pillars of the company, right?
That's right. Companies that make up a very large chunk of Berkshire's value.
And the first one is, surprise, surprise,
The insurance cluster, which Berkshire owns 100% of.
makes sense given the float we just discussed?
Absolutely. The letter reiterates why. The product will never be obsolete, sales grow with the economy and inflation, and crucially, integrity and capital will forever be important. It's tailor-made for Berkshire.
Okay, giant number one, insurance. What's number two?
Number two, by market value at the time, was Apple.
Apple. Now that surprised a lot of people, didn't it? Buffett traditionally avoided tech.
He did, but I think he came to see Apple less as a pure tech company and more as an incredibly powerful consumer products company with a fiercely loyal customer base that fits his durable economic advantage criteria.
Okay, so he sees the brand and the ecosystem as the moat. How much do they own?
At the end of 2021, it was 5.55%. And here's a fascinating bit. That percentage actually increased from 5.39% the year before without Berkshire spending a dime.
How does that work?
Apple's own share repurchases. As Apple bought back its own stock, Berkshire's slice of the remaining pie got bigger automatically.
Clever. So they benefit directly when Apple buys back shares.
Hugely. Berkshire only got $785 million in dividends from Apple that year, but their share of Apple's total earnings was, wait for it, a staggering $5.6 billion.
Wow. Mostly thanks to those buybacks boosting their ownership stake.
A big chunk of it, yeah. And Buffett gives a shout out to Tim Cook, saying he regards users of Apple products as his first love, but everyone benefits from his management.
Okay, so insurance, Apple. Who's giant number 3?
BNSF, the Burlington Northern Santa Fe Railroad.
The railroad. Right, infrastructure again.
Exactly. Described as the #1 artery of American commerce and an indispensable asset for America. The letter also notes the environmental plus rail is much more carbon efficient than trucking for long distances.
And how's it doing financially?
Record earnings in 2021. $6 billion. And Buffett makes a point of saying this is calculated using old-fashioned sort of earnings after all costs, like interest, taxes, depreciation, amortization, the works.
He's contrasting that with some modern accounting practices.
Yeah, he calls out what he terms deceptive adjustments that some companies use, which might exclude real costs to make earnings look better. He prefers the unvarnished truth.
Got it. And the scale's huge.
Immense. In 2021, BNSF trains traveled 143 million miles, carrying 535 million tons of cargo. It's just a powerhouse mover of goods.
Okay, and the final giant, number 4.
BHE, Berkshire Hathaway Energy, another infrastructure play.
Energy. Makes sense. How are they doing?
Also, record earnings in 2021, $4 billion. And get this, that's up 30-fold from $122 million back in 2000 when Berkshire first invested. They now own about 91% of it.
A 30-fold increase in earnings. What's driving that?
A huge transformation. BAG had basically no wind or solar back in 2000. Now it's a utility powerhouse and a major leader in renewable energy and transmission across large states of the U.S.
So they're big in renewables.
Very big. And the letter stresses this isn't just greenwashing. They've been detailing their plans and progress since 2007, and BHE essentially reinvests all of its earnings back into the business, particularly into these climate-focused projects.
That's quite a commitment. So if you connect the dots on these 4 giants.
You see, it's not just about, numbers on a page. It's insurance providing the capital, and then major investments in indispensable parts of the economy. Vital consumer tech with Apple, the main artery of commerce with BNSF, and a huge energy provider moving towards renewables with BHE. They're deeply intertwined with how the country functions.
It's a fascinating picture. So let's talk about where they put their money, capital deployment. Berkshire is famous for sitting on a lot of cash sometimes.
Oh, yeah. At the end of 2021, the letter states they held $144 billion in cash and cash equivalents.
$144 billion. That's enormous. Where do they keep it?
Mostly in very safe, short-term stuff. $120 billion of it was in U.S. Treasury bills maturing in less than a year.
Okay, so very liquid, very safe. And they have this pledge, right, about always having cash on hand.
They do. They pledge to always hold more than $30 billion in cash. It ensures their financial impregnability, as Buffett puts it. They never want to be dependent on the kindness of strangers or even friends for money.
Financial fortress kind of thing. But still, $144 billion.
Yeah.
Why so much? Especially for a company that loves owning businesses. It seems almost, counterintuitive.
It does seem like a paradox, doesn't it? But the letter is clear. This huge pile isn't because they've suddenly become super patriotic bond investors or because they've lost their preference for owning businesses.
So what is the reason then?
It's simple, according to Buffett. It's a consequence of my failure to find entire companies or small portions thereof, that is, marketable stocks, which meet our criteria for long-term holding.
So it's not a lack of desire, it's a lack of compelling opportunities at the right price.
Exactly. It's a testament to their discipline. They won't buy just for the sake of buying. They'd rather wait, hold the cash, than overpay or buy something that doesn't meet their strict standards. That patience, that willingness to do nothing when the pitches aren't great, that's a key insight for any investor, I think.
It really is. Resisting that urge to constantly do something. He even mentions his very first investment, right? Back in 1942.
Yeah, a little anecdote. March 11th, 1942, he bought 3 shares of City Services preferred stock for $114.75, all the money he had. The Dow Jones closed at 99 that day. Things looked bleak.
And his takeaway?
Never bet against America. A simple, powerful belief that's clearly stuck with him.
Definitely. So besides buying whole businesses or stocks, the letter talks about a third way they increase value: share repurchases.
Right. Buying back Berkshire's own stock. Buffett calls it the easiest and most certain way for us to increase your wealth if the price is right, meaning below their estimate of intrinsic value.
And they've done a lot of that recently.
Quite a bit. Over the 2 years leading up to the letter, they spent $51.7 billion to repurchase about 9% of their outstanding shares.
So what does that mean for the remaining shareholders?
It means each remaining share now represents a larger piece of the pie. Continuing shareholders effectively owned about 10% more of all of Berkshire's businesses, the railroad, the energy company, Apple, everything, just because the company bought back shares.
And it increases something else too, right? Related to the float.
Good catch. Yes, it also automatically increases the amount of that valuable insurance float backing each remaining share. That went up 25% per share over those 2 years. So buybacks enhance value in multiple ways for the ongoing owners.
But he also says their own shareholder base kind of limits how many shares they can buy back.
Yeah, it's an interesting point. He says Berkshire has a high-class investor base, people who tend to buy and hold for the long term, like Buffett himself. They're not actively trading in and out.
So there aren't as many shares available for sale at opportunistic prices.
Exactly, which limits how aggressive they can be with buybacks. But he also says these are precisely the kind of long-term partners they prefer as shareholders.
It's all about that long-term alignment. Which brings us to a really great story in the letter, one that highlights the human side of all this.
Yeah.
The story of Paul Andrews.
Ah, yes, the founder of TTI, which is now a Berkshire subsidiary. Buffett describes him as someone who just quietly embodied all the qualities they admire.
Tell us about him. How did he start?
He got laid off from General Dynamics back in '71, took his $500 in savings, started a tiny electronics distributor called Textronics. First-year sales were just $112,000.
$500 startup.
Yeah.
And it grew.
Did it ever? By 2006, it was doing $7.7 billion in annual volume. A huge success story.
Incredible. But then he faced a dilemma.
Yeah, he was 63. He'd seen a friend's successful business basically fall apart after the friend died unexpectedly. He started worrying about what would happen to TTI, to his employees, his legacy, if something happened to him.
So he considered selling.
He did. He looked at selling to a competitor. That made economic sense, synergies, cost-cutting. But it would inevitably mean job losses for his team, people he'd worked with for years, and likely moving the HQ away from Fort Worth.
And he didn't want that.
Not at all. He said not for him. Then he looked at selling to a financial buyer, like a private equity firm.
A leveraged buyout kind of thing.
Right. But he saw that as just handing his 35-year-old creation over to a reseller who would likely load it with debt and look for a quick exit strategy. He had zero interest in that either.
He really cared about the company's future and its people.
Deeply. So, having rejected those options, he apparently went to meet Buffett and said something like, "You are the only guy left."
Wow. One meeting, one lunch.
One deal. Done. It was a perfect fit. Berkshire offered a permanent home where the culture and people would be valued.
And how did TTI do under Berkshire?
It thrived. Employees grew from about 2,400 to over 8,000. Earnings went up 673%. And get this little detail. Buffett apparently kept offering Paul Andrews salary increases, and Paul kept deferring them.
That says a lot about him. It's a fantastic story about values, loyalty, finding the right home for a business.
It really is. But here's the kicker, the really crucial connection that the letter draws out.
Go on.
Paul Andrews choosing Berkshire over other buyers. That decision indirectly led to what Buffett calls Berkshire's most important acquisition.
Okay, what's the link?
So, because TTI was now part of Berkshire and based in Fort Worth, the Berkshire Board of Directors decided to hold a meeting there in 2009 and visit TTI.
Okay.
And while Buffett was in Fort Worth for that meeting, he finally met Matt Rose, who was the CEO of BNSF Railroad, which was also headquartered in Fort Worth.
Ah, the railroad connection.
Exactly. And this meeting happened right when BNSF had just released a pretty bad earnings report because the Great Recession was hitting railroad volumes hard.
Oh.
The stock was down. The company looked a bit vulnerable.
Perfect timing almost.
Serendipitous timing.
Yeah.
Buffett met Rose, heard about the railroad situation, and made an offer the very next day.
The next day, yep.
11 busy days later, the letter says, Berkshire and BNSF announced a firm deal.
Wow. So if Paul Andrews hadn't cared so much about his employees and sold to Berkshire,
Buffett might not have been in Fort Worth at that specific time, might not have met Matt Rose just as BNSF looked viable, and Berkshire might never have acquired the railroad.
that's incredible. It really makes you wonder, doesn't it? How much of huge success is purely rational calculation and how much is, well, serendipity in building these strong relationships over time?
It's a great question. This story suggests that even the biggest, most strategic deals can hinge on human connection, trust, and just being in the right place at the right time, which often happens because you built the right relationships beforehand.
And Buffett clearly thinks BNSF was a monumental deal. He predicts it will be a key asset for Berkshire and our country a century from now.
High praise indeed. It underscores the power of those connections.
So wrapping things up, the letter gets quite personal towards the end. It talks about the ultimate why for Buffett. Why does he keep doing this?
Yeah, it's not just about the money anymore, clearly. He talks about his experience teaching and this funny idea he calls the orangutan effect.
The orangutan effect.
His point is that if you try to explain ideas you really care about, even just to an orangutan or, a class of students, it forces you to clarify your own thinking. You understand it better yourself.
Makes sense. Teaching is learning.
Right. And he shares the advice he gives university students. Find work in a field you love, with people you'd choose to be around even if you didn't need the money.
Because then it doesn't feel like work anymore.
Exactly. He says when you find that, you no longer be working. He feels he and Charlie found that at Berkshire, working with people they genuinely like and trust. His simple rule: no jerks.
Huh? Good rule. And this ties into his relationship with Berkshire's shareholders.
It does. He says the most rewarding part for him is working for you, meaning the shareholders, particularly the individuals who've trusted Berkshire for the long haul.
He acknowledges they can't pick their owners, right? It's a
No.
public company.
Right. They get speculators, index funds, all sorts. But he highlights what he sees as a truly unusual degree of long-term individual owners who come in with an attitude approaching till death do us part. People who often trust Berkshire with a huge portion of their life savings.
That's a heavy responsibility.
It is, and he suggests that while Berkshire might not always be the absolute best performing investment choice every single year, it ranks very high among the companies with which they would be most comfortable.
Comfort. That's an interesting word in investing.
It is, and he makes a profound point connecting it to results. He writes, people who are comfortable with their investments will, on average, achieve better results than those who are motivated by ever-changing headlines, chatter, and promises.
Wow. So investment psychology matters. Being comfortable helps you stay the course and avoid panic selling or chasing fads.
That's the clear implication. It's a powerful statement about the human side of investing, beyond just the numbers. Comfort leads to better long-term behavior, which leads to better results.
So let's try to recap this deep dive into the 2021 Berkshire letter. We've seen the absolutely mind-blowing long-term performance.
Driven by that business picker philosophy, not market timing.
Right. We saw the surprising reality of Berkshire as a massive owner of core U.S. infrastructure, not just a financial entity.
And a huge contributor to the U.S. Treasury, illustrating that link between business success and national finances. We also demystified the insurance float a bit.
We looked at the four giants insurance: Apple, BNSF, BHE, these pillars of the company and the economy.
Showing their disciplined capital allocation, the power of buybacks, and that incredible story of how human connection, through Paul Andrews and TTI, led to the BNSF acquisition.
And finally, that ultimate why. The focus on working with good people, for trusting long-term shareholders, and the idea that investment comfort is key to long-term success.
It covers so much ground, really.
It really does. So maybe the true secret formula, if there is one, isn't just about crunching numbers or finding the next hot stock, is it?
It seems much broader than that. It's about identifying and really nurturing relationships with the businesses you own, the people running them.
And maybe most importantly, with your own investment philosophy. Understanding what lets you sleep at night, what keeps you comfortable.
Exactly. And the people, or the company philosophy, you choose to trust with your savings over the long run. It suggests it's less about watching the daily market swings.
And more about having that deep-seated comfort and confidence in your long-term partners, whether that's a company like Berkshire or your own well-understood strategy. Something to think about for sure.
Definitely food for thought for any investor. How do you achieve that comfort? How does understanding the business help you ignore the noise?
Great questions to ponder.